In 2008, the banks failed and the taxpayers paid. Bailout. Trillions of dollars created by the Federal Reserve and Congress to rescue institutions that had gambled recklessly with other people's money. The banks survived, the executives kept their bonuses, and you got the bill through inflation and national debt. They told you it would never happen again. They passed laws, created regulations, built frameworks to prevent future bailouts, and they were telling the truth. There will not be another bailout. What they did not tell you is what replaces it. It is called a bail-in, and in a bail-in, the money does not come from taxpayers. It does not come from the Federal Reserve. It comes from you, directly from your bank account, your savings, your deposits, converted overnight into worthless stock in a failing bank. This is not a hypothetical scenario. It is not a conspiracy theory. It is written into law. It is the official policy of the United States government, the Federal Reserve, and every major central bank in the world. The legal framework is complete. The procedures are documented. The only thing missing is the trigger. When the next banking crisis hits, and it will hit, your money will not be protected. It will be conscripted, drafted into service to rescue the very institution that lost it in the first place. Let me show you exactly how bail-ins work, what the law actually says, and why your bank account is not as safe as you think. To understand why bail-ins are coming, you need to understand why bailouts are gone, because the 2008 playbook cannot be repeated. The political, economic, and legal conditions that allowed bailouts have fundamentally changed. In 2008, when Lehman Brothers collapsed and the financial system seized up, the government responded with unprecedented intervention. The Troubled Asset Relief Program authorized $700 billion in taxpayer funds to rescue banks. The Federal Reserve created trillions more through emergency lending facilities. AIG was bailed out. Fannie and Freddie were bailed out. The automakers were bailed out. Everyone was bailed out except the homeowners who lost their houses. The public was furious. The Tea Party movement emerged on the right. Occupy Wall Street emerged on the left. Both shared the same rage. Bankers got rich. Bankers failed. Bankers got rescued. Ordinary people got nothing. Politicians heard the message. No more bailouts became a bipartisan demand. The Dodd-Frank Act of 2010 was explicitly designed to end bailouts. It created the Orderly Liquidation Authority, a mechanism to wind down failing financial institutions without taxpayer money. But here is what the public missed. Ending bailouts does not mean banks will not be rescued. It means they will be rescued differently. The money has to come from somewhere. If it cannot come from taxpayers, it must come from someone else. Dodd-Frank answered the question of who. The answer is creditors, and in legal terms, depositors are creditors. When you deposit money in a bank, you are not putting it in a vault with your name on it. You are lending money to the bank. Your deposit is a liability on the bank's balance sheet. You are an unsecured creditor of the bank. You have a claim, but that claim ranks below secured creditors, below derivative counterparties, below many other obligations. This legal reality has always existed. But it did not matter when the government would bail out any bank that failed. Your claim was protected by implicit government guarantee. That guarantee has been explicitly withdrawn. The Dodd-Frank framework, combined with international agreements through the Financial Stability Board and the G20, created a new system. When a systemically important bank fails, creditors take losses to recapitalize the institution. Depositors are creditors. Depositors take losses. Your savings become bank capital. This is not interpretation. This is the law. Let me walk you through exactly how a bail-in operates, because understanding the mechanism reveals how exposed you actually are. Step 1. A systemically important bank experiences severe distress, losses on commercial real estate, derivative exposure gone wrong, a bank run triggered by social media. The cause does not matter. What matters is that the bank cannot meet its obligations. Step 2. The FDIC and Federal Reserve determine that the bank is failing or likely to fail. They invoke the Orderly Liquidation Authority. The bank is placed into receivership. This happens over a weekend, just like traditional bank failures, but with a critical difference. Step 3. The FDIC implements the Single Point of Entry Resolution Strategy. This is the official name for the bail-in procedure. the holding company of the bank is placed into receivership. The operating subsidiary, the actual bank where your deposits sit, continues functioning, but the liabilities are restructured. Step 4. This is where your money gets taken. Creditors of the holding company, which includes unsecured bondholders and certain depositors, have their claims converted to equity. Your deposit, which was a debt the bank owed you, becomes stock in the reorganized institution. The conversion rate is whatever the FDIC determines is necessary to recapitalize the bank. If the bank needs $50 billion in new capital and creditor claims total $100 billion, you might get 50 cents on the dollar in stock. That stock is in a bank that just failed. Its market value might be pennies. Let me give you a concrete example. Suppose you have $500,000 in a savings account at a major bank. The FDIC insures $250,000, so you are protected up to that level. But the other $250,000 is uninsured. The bank fails and enters orderly liquidation. The FDIC determines that a 40% haircut on uninsured deposits is necessary to recapitalize the institution. Your uninsured $250,000 becomes $150,000 in stock in the reorganized bank. You have lost $100,000 instantly, and the stock you received might lose even more value. But here is what most people do not understand. The $250,000 FDIC insurance limit is not guaranteed to protect you either. The FDIC insurance fund holds approximately $128 billion. Total insured deposits in the American banking system exceed $10 trillion. The coverage ratio is approximately 1.17%. If a major bank fails, the FDIC can cover it. If several major banks fail simultaneously, the math does not work. The FDIC would have to borrow from the Treasury. The Treasury would have to fund that borrowing through more debt. The debt would have to be monetized by the Federal Reserve. The process would be inflationary. Even if you technically receive your insured deposits, the purchasing power of those dollars might be significantly reduced by the inflation created to fund the insurance. There is no perfect protection. There is only understanding the risk and positioning accordingly. Now let me show you the specific legal documents that authorize this. The FDIC and Federal Reserve jointly published a document in 2013 titled Resolving Globally Active, Systemically Important Financial Institutions. This document explicitly describes the single point of entry strategy for bail-ins. On page 11, it states, the unsecured debt and, if necessary, the equity of the top-tier holding company would be available to absorb losses and provide capital. On page 13, it clarifies that this includes long-term unsecured debt and other liabilities. Uninsured deposits are liabilities. The document makes clear that the goal is to recapitalize the bank without taxpayer money. The money comes from creditors instead. This is the official policy of the United States government. The bail-in framework is not unique to America. It is a global standard adopted by every major economy. Understanding this reveals how coordinated and deliberate the policy is. The Financial Stability Board, which is an international body that coordinates financial regulation among G20 nations, published the Total Loss Absorbing Capacity Standard in 2015. This standard requires global, systemically important banks to hold a minimum amount of liabilities that can be converted to equity during a bail-in. In plain English, banks are required to have enough creditor money available to confiscate during a crisis. This is baked into the international regulatory framework. It is a feature, not a bug. The European Union implemented the Bank Recovery and Resolution Directive in 2014. This directive explicitly authorizes bail-ins for failing banks. Deposits above the insurance limit are specifically included as bail-in-able liabilities. The United Kingdom has similar legislation. Canada has similar legislation. Japan has similar legislation. Every major economy has adopted the bail-in framework. This is global policy coordinated at the highest levels. Why did they all adopt the same approach? Because they all face the same problem. Governments are too indebted to fund bailouts. The 2008 bailouts pushed many nations to dangerous debt levels. Another round of trillion-dollar rescues would trigger fiscal crises, sovereign debt downgrades, currency collapses. Bail-ins solve this problem by shifting the cost from government balance sheets to private creditors. The banks are rescued. The financial system survives. The government does not go deeper into debt. The only people who pay are the depositors and bondholders who trusted the institution. From a government perspective, this is elegant. From your perspective, it is theft. Let me give you the timeline of how this developed. The financial crisis demonstrates that bailouts are politically unpopular and fiscally dangerous. The G20 begins discussing alternatives to bailouts. The concept of bail-in emerges. Dodd-Frank passes in the U.S., creating the Orderly Liquidation Authority. The Financial Stability Board publishes its first guidance on resolution frameworks. The FDIC and Federal Reserve publish the joint paper describing single point of entry. Cyprus implements a bail-in, converting deposits above the insurance limit to equity. This is the first major test of the framework. The European Union adopts the Bank Recovery and Resolution Directive. The Financial Stability Board publishes the TLAC Standard 2016-2024. Banks build up loss-absorbing capacity. Regulatory frameworks are refined. Procedures are tested through exercises. The framework is complete. The infrastructure is in place. Everything is ready. They are just waiting for the crisis. The bail-in is not theoretical. It has already happened. Cyprus 2013 is the template for what is coming to America. In March 2013, Cyprus faced a banking crisis. Two major banks, Bank of Cyprus and Laiki Bank, were insolvent. They had invested heavily in Greek government bonds, which had collapsed in value. The banks could not meet their obligations. Cyprus approached the European Union and the IMF for a bailout, but the Troika, as it was called, demanded something different. They demanded that Cyprus implement a bail-in. Here is what happened. Laiki Bank was dissolved. Deposits under 100,000 euros were transferred to Bank of Cyprus. Deposits over 100,000 euros were frozen. At Bank of Cyprus, deposits over 100,000 euros were converted to equity. The conversion rate was 47.5%. If you had 200,000 euros in the bank, 100,000 was insured and protected. The other 100,000 was bailed in. You received approximately 52,500 euros in bank stock. You lost 47,500 euros instantly. But the losses did not stop there. The bank stock you received was nearly worthless. It had no market. It had no liquidity. It represented equity in an institution that had just failed. The effective loss for many depositors exceeded 80%. The restrictions were severe. Capital controls were imposed. Withdrawal limits of 300 euros per day. No transfers outside the country. Some restrictions lasted for 2 years. Your money was in the bank. You could not access it. And when you finally could, much of it was gone. The Cypriot bail-in was described by officials as a one-time measure for a unique situation. They said it would not be repeated. They lied. The bail-in became the template. Since Cyprus, the framework has been strengthened. The rules have been refined. The procedures have been tested. What happened in Cyprus is now the official playbook for every major economy. There have been smaller bail-ins since. Italian banks have implemented bail-in procedures. Spanish banks have used them. Portuguese banks have used them. Each time, depositors above the insurance limit have taken losses. The pattern is consistent. Banks fail, depositors pay, and each time officials say it was necessary to preserve financial stability. Now imagine this happening at a major American bank, a bank with hundreds of billions in deposits, a bank that millions of people depend on. The scale would be vastly larger, the disruption would be vastly greater, but the mechanism would be identical. Your deposit above $250,000 would be converted to stock. Your access to funds would be restricted. Your savings would become bank capital overnight. And you would be told it was necessary, that there was no alternative, that you should be grateful the system survived. Let me explain exactly how bail-in risk affects you personally. Because this is not just about wealthy people with millions in the bank. The risk extends to anyone with money in the financial system. First, the $250,000 FDIC limit creates false confidence. Most people believe their deposits are safe because they are under the insurance limit, but the insurance only works if the FDIC has enough money. If multiple banks fail simultaneously, the fund is insufficient. The FDIC would have to borrow. That borrowing would take time. During that time, your deposits might be frozen. You might not be able to access your money for days or weeks. When you finally receive it, inflation might have reduced its value. Being under the insurance limit does not make you immune. It makes you slightly less exposed. Second, business accounts are extremely vulnerable. Most businesses have operating accounts far exceeding $250,000. Payroll accounts, revenue accounts, reserve funds. These accounts are largely uninsured. In Cyprus, businesses were devastated. Companies that had done nothing wrong saw their operating capital confiscated. They could not pay employees. They could not pay suppliers. They could not function. Many went bankrupt, not because their business failed, but because their bank failed. If your employer's bank accounts are bailed in, you might not get paid. The risk extends beyond your personal accounts to every institution you depend on. Third, retirement accounts are not immune. Your 401k and IRA probably hold bonds and bond funds. Some of those bonds are issued by banks. In a bail-in, bank bonds can be converted to equity or written down entirely. Your retirement portfolio could take losses through exposure you did not even know you had. Money market funds, which are supposed to be safe, often hold short-term bank debt. Commercial paper, certificates of deposit. These instruments are bail-inable. The safe money in your retirement account is exposed. Fourth, the trigger event is unpredictable. Cyprus did not know it would have a banking crisis until it did. Neither did Iceland, neither did Greece. Banking crises arrive suddenly. They spread rapidly. The trigger could be a real estate collapse, a derivative failure, a cyber attack, or a social media bank run. By the time the crisis is visible, the bail-in is imminent. There is no time to act. The weekend closure happens. The Monday morning brings the announcement. Your money is gone before you knew it was at risk. Fifth, political protection does not exist. In 2008, there was political will to bail out depositors with taxpayer money. That political will has been exhausted. The public will not accept another bailout. Politicians know this. They have explicitly designed a system that does not require their approval. Bail-ins happen through regulatory authority. The FDIC and Federal Reserve can implement single point of entry without congressional authorization. They do not need to ask permission. They do not need to hold hearings. They act over a weekend and announce on Monday. You have no political protection, no recourse, no appeal. The law authorizes the confiscation. The regulators implement it, and you absorb the loss. So how do you protect yourself from bail-in risk? How do you position your finances to survive the confiscation that is legally authorized and procedurally ready? Step 1. Understand your exposure. Look at every account you hold at every bank. Calculate how much is above the $250,000 FDIC limit. This is your uninsured exposure. This is the money that is explicitly at risk in a bail-in. But do not stop there. Look at your exposure through ownership categories. The $250,000 limit applies per depositor, per bank, per ownership category. Joint accounts have separate coverage. Trust accounts have separate coverage. You might be able to structure accounts to increase your insured amount. Consult with a financial professional who understands FDIC coverage rules. Maximize your insured position through proper account titling. Step 2. Diversify across multiple banks. The bail-in risk is institution-specific. If Bank A fails, your deposits at Bank B are not affected. By spreading deposits across multiple banks, you reduce the impact of any single failure. Do not keep more than $200,000 at any single institution. Leave a cushion below the insurance limit. Use 3, 4, or 5 banks if necessary to stay under the threshold at each one. Consider including a credit union. Credit unions are insured by the NCUA, a separate insurance fund. Diversifying across insurance funds provides additional protection. Step 3. Hold physical cash outside the banking system. Cash in your safe is not subject to bail-in. It cannot be converted to equity. It cannot be frozen during a bank resolution. Keep 2 to 4 weeks of essential expenses in physical cash at home. More if your resources allow. This is your bridge liquidity during a banking crisis. It allows you to buy groceries, pay essential bills, and survive while the system sorts itself out. If you have modest savings, keep $500 to $1,000 in cash. If you have more substantial resources, keep $3,000 to $5,000. Scale to your situation. Step 4. Build assets outside the banking system entirely. This is the ultimate protection. Assets that are not deposits cannot be bailed in. Physical gold and silver are not bank liabilities. They cannot be converted to equity in a failing bank. They sit in your safe or your vault, outside the system, immune to bail-in. If you have $500, buy 15 ounces of silver. Begin building your position outside the banking system. If you have $2,500, buy 70 ounces of silver and a quarter ounce of gold. Diversify within precious metals. If you have $10,000, buy 200 ounces of silver and 1 ounce of gold. Consider a home safe and private vault storage. If you have $50,000, allocate $12,000 to $15,000 to physical metals. 400 to 500 ounces of silver, 3 to 4 ounces of gold. This is substantial protection against bail-in risk. If you have $100,000 or more, target 25% to 30% in physical assets outside the banking system. This mirrors what the sophisticated money does. They understand the risk. They position accordingly. Step 5. Monitor bank health indicators. Watch for warning signs at your specific bank. Declining stock prices, executive departures, credit rating downgrades, negative headlines, rising deposit outflows. If you see multiple warning signs, act immediately. Move deposits to healthier institutions. Increase your cash position. Accelerate precious metals purchases. Do not wait for the weekend closure. Step 6. Think beyond insurance limits. Even insured deposits carry risk in a systemic crisis. The FDIC fund might be insufficient. The resolution might take weeks. The inflation created to fund payouts might erode value. Structure your financial life to minimize dependence on the banking system. Own assets directly. Build income streams outside traditional employment. Develop skills that generate value regardless of financial system stability. The bail-in framework is designed to rescue the system by sacrificing depositors. The only protection is not being a depositor, or at least not being entirely dependent on deposits. Bailouts are over. Bail-ins are the law. Your deposit above the insurance limit is legally available to recapitalize a failing bank. The framework is built. The procedures are tested. Cyprus proved the concept. They are just waiting for the crisis. When it comes, you will have no warning. A weekend closure, a Monday announcement, your savings converted to worthless stock before you knew anything was wrong. But there is one specific indicator that signals when bail-in risk is elevated. It tracks the health of the banking system in real time. It spiked before Cyprus. It spiked before Silicon Valley Bank. And right now, it is approaching levels not seen since 2008. I reveal exactly what that indicator is and how to monitor it in this video right here. Click it now. The bail-in framework is loaded. The trigger is approaching. Make sure your money is protected before it fires. I will see you there.